The Fed's decision to cut rates, understanding the real reason behind it. The Federal Reserve recently concluded its last meeting of 2023, announcing that it will be keeping interest rates steady. However, they also indicated that there may be 3 interest rate cuts coming next year. This has led many to believe that the Fed has finally shifted its stance to lowering rates, as the rate of inflation is on the decline. In the next few minutes, we will explore the real reason behind the Fed's decision to cut rates and its potential implications. Market expectations. Interestingly, the market is now pricing in even steeper rate cuts than what the Federal Reserve itself expects. The market is currently pricing in 1.5% in interest rate cuts for next year, which is twice as much as what the Fed anticipates. While some may view this as a sign that inflation and interest rates will remain low for an extended period, it's important to consider the long-term perspective. Long-term perspective. Even during the 1970s, which saw one of the most aggressive rate hiking periods in modern history, there were still periods of steep interest rate cuts. It appears that we may be entering a new long-term cycle, with interest rates headed higher, despite the short-term cuts. It's crucial to keep this in mind when analyzing the current rate cut announcement, discrepancy between expectations and inflation. Additionally, there has been a discrepancy between expectations of deflation and the actual rate of inflation. Despite the official rate of inflation staying above 3%, asset prices have responded to the expectations of rate cuts in 2024 by soaring. Gold is back above $2,000 per ounce, silver is nearing $24, Bitcoin is hovering around $43,000, and stock indices like the S&P 500 and Dow have reached all-time highs. Bond investors are also benefiting, with Treasury yields surging the most since March. Importance of diversification. Diversification and a long-term perspective are key to navigating the ever-changing financial landscape. Federal Reserve Chairman Powell's remarks. During the press conference, Federal Reserve Chairman Powell addressed several key points. Firstly, he clarified that the interest rate cuts mentioned were simply expectations and not yet an official plan. Secondly, he emphasized that the Fed's plan for interest rates differs from its plan for its balance sheet. While both are tools of monetary policy, they are currently moving in opposite directions. Lastly, Powell mentioned that a recession is guaranteed for 2024, citing the slowdown in economic activity and the cumulative effect of monetary policy tightening. Quantitative easing and quantitative tightening. Let's discuss the concept of quantitative easing, QE, and quantitative tightening, QT. QE involves the Fed buying assets such as treasuries and mortgage-backed securities, injecting cash into the financial system. This stimulates the economy. On the other hand, QT refers to the shrinking of the Fed's balance sheet as assets are paid back, effectively reducing the amount of cash in circulation. Powell stated that QT will continue, even if interest rates are lowered, as the Fed aims to maintain a restrictive stance on the economy. Conclusion. While the Federal Reserve has indicated the possibility of interest rate cuts next year, it's important to consider the long-term perspective and the potential for higher rates in the future. The market is pricing in even steeper cuts than the Fed expects, and asset prices have responded accordingly. Finally, Powell mentioned that a recession is guaranteed for 2024, and the Fed's plans for interest rates and its balance sheet are moving in different directions. As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.